Hello everyone, I'm Cade Bekanich, Certified Financial Planner, and today we're examining President Trump's tariff strategy and its potential impact on the US economy and the world economy as a whole. Let's break down what you need to know about these significant economic policy changes. First, let's understand the scale of what we're discussing. The 2025 Trump tariff represents the largest tax hike since 1982. The average tariff rate on imports has jumped from 2.5% to 16.5%, making it the highest since 1937. This is a fundamental shift in the United States trade policy that affects virtually every sector of our economy. And some American industries are actually seeing benefits from these tariffs. US steel and aluminum producers, for instance, have reported increased production, growth, and improved financial performance just over the past few weeks. These protected industries have used the tariffs to shield and expand operations and invest in new facilities, creating manufacturing jobs in these specific sectors. The administration's stated goal with these tariffs is addressing U.S. deficit, which exceeded $1 trillion in goods last year. By imposing costs on imports, the strategy aims to create more balanced, reciprocal trade relationships where access to the American market is leveraged to secure better terms for U.S. exports and international businesses. This approach treats trade imbalances as a problem requiring correction rather than a natural economic outcome. So far beyond just trade numbers, the White House positions these tariffs as a national security measure. The argument is that excessive dependence on foreign suppliers for critical goods creates vulnerability for our country. So by encouraging domestic production of essential items, the tariffs aim to strengthen economic sovereignty and reduce strategic risks, particularly in sectors considered vital to national security. And when it comes to money, during previous rounds of tariffs, we saw significant capital investment in protected industries, steel producers being one of them. Steel producers announced more than $15 billion in new or upgraded domestic facilities. And of course, this demonstrates tariffs can stimulate domestic capital formation in targeted sectors, potentially modernizing manufacturing capacity. The breakdown of it is that this demonstrates that tariffs can increase capital production in our country. And tariffs themselves do provide the administration with economic leverage that extends far beyond just trade issues. By imposing costs on trading partners, the U.S. gains bargaining power that can be applied to various international negotiations, from security concerns to immigration policy. This tool itself allows the administration to use economic pressure to pursue broader policy objectives with other nations. Now let's examine the challenges. U.S. manufacturers relying on imported components faced increased costs and potential production days every day since these tariffs began. Many American companies have built complex global supply chains over decades, and sudden tariff increases disrupt these carefully constructed networks. Companies must either absorb these costs, pass them on to the consumers, or undertake expensive, time-consuming processes to find new suppliers. But how is this impacting local jobs? While tariffs protect jobs in some industries, they potentially threaten more jobs in sectors that use those protected materials. For example, while steel tariffs may support 80,000 jobs in steel production, they affect costs for the 12 million jobs in industries that use steel. This creates an asymmetric impact where concentrated benefits for some workers come at a diffuse cost to many others. Financial markets have responded with major concern to these tariff announcements. We've seen significant stock market volatility, with major exporters like Boeing experiencing substantial share price declines. The Dow fell nearly 4% following recent tariff announcements, its biggest one-day percentage loss since June 2020. This market reaction reflects investor uncertainty about the economic consequences of these trade policies. However, economists do project that the 2025 tariffs will increase consumer prices by 2.3% in the short term. But what about the long term? This comes at a time when many Americans are already concerned about inflation. And these price increases affect a wide range of consumer goods, from appliances and electronics to clothing and food, potentially putting additional pressure on household budgets across all income levels. In practical terms, these price increases translate to an estimated additional cost of about $1,900 to $3,800 annually for the average U.S. household. This represents a real reduction in purchasing power for American families, which makes it much more difficult to afford day-to-day living. And this impact may be especially significant for lower-income households that spend a higher percentage of their income on goods rather than services. Another challenge for the U.S. is that trading partners are simply not just accepting these tariffs. Of course, there's going to be pushback. China, Canada, and the European Union have already announced counter tariffs affecting approximately $330 billion of U.S. exports. These retaliations specifically target U.S. products, creating particular challenges for American exporters and the communities where they operate. This escalation raises concerns about a broader trade war with unpredictable consequences. So who knows what's to come of this? From a fiscal perspective, the tariffs are estimated to generate $258.4 billion in federal revenue in 2025. This represents a significant shift in how government operations are funded, essentially transferring more of the tax burden to importers and ultimately to consumers of imported goods. This revenue increase comes outside the normal legislative process for tax changes in the United States. And because of this, the Federal Reserve now faces a much more complicated policy environment. If tariffs simultaneously increase inflation while slowing economic growth, a combination economists call stagflation, the Fed's traditional tools become much less effective. Raising interest rates to fight inflation could further slow growth in our country, while lowering interest rates to stimulate growth growth could worsen inflation. This policy dilemma creates additional uncertainty for businesses and investors alike. Finally, we need to consider the broader economic risks. Major financial institutions have increased their recession probability forecasts. JP Morgan now seeing a 60% chance of global recession by year-end, up 40% from previous year, raising concerns about a synchronized global slowdown that could amplify domestic economic changes. As we've seen, President Trump's tariff strategy creates a complex mix of potential benefits for some sectors, significant challenges for others. The full impact will depend on implementation details, potential negotiations, and market adaptations that cannot be predicted with certainty. As a financial professional, I could only encourage you to consider how these economic changes will impact your portfolio and your retirement plan. While today I've shared with you very factual information, remember that economic conditions can change rapidly and past performance never guarantees future results. And although this wasn't advice, thank you for watching. And remember, this is not financial advice, simply my observation of the markets. I'm Cade Bekanich, certified financial planner. Thank you again for watching as I look forward to keeping you informed about economic changes.